Hi everyone, welcome to today's video. So I recently took a loan of 1 crore rupee in order to buy a villa in Goa. On this video, I'm going to help you understand the math behind why I have taken that loan. What benefits am I going to derive out of taking that loan? More specifically, I will tell you how am I going to 4x my investment almost in the next 10 years using this loan. I will show you the math behind it. In the second half of the video, I will help you understand how you can benefit by taking loans yourself. Please understand that this is a dangerous game. Please watch this video entirely. Only then you will be able to understand the concept. This is not an entertainment video. You are putting your hard-earned money on the line. So please understand the concept behind it. And I will speak from very practical experiences. If you like the content, please press the like button. It would allow these type of videos to reach out to more people. In fact, do press the like button and we will get started. Also, this video has been brought to you by upGrad. More about them subsequently on the video. So let me take you to my whiteboard and start explaining the context. So I have recently purchased a villa in Goa. Now, what do I own? Let me give you a very quick understanding. So I own a villa. It's a constructed villa. I own the land and it has a running business on it. What is the running business? It's Airbnb, and the property is already listed on Airbnb and it is already generating rental income. So this is the nature of the investment that I have made. Now, how have I been able to finance this? So I have taken a loan of 1 crore rupee. I have invested right off the bat 90 lakhs as down payment. Now for this 1 crore rupee, I am paying an EMI of 80,000 rupees monthly. And how much money am I making through this Airbnb rental business? I am making roughly 81,000 rupees. So net, what is my outflow on every month basis? It is close to zero because I am making 81,000 rupees and I am paying an EMI of approximately 81,000 rupees. So it gets nullified and my investment amount comes out to be 90 lakh rupees. So I hope all of us are aligned up until this point. Now you will have a set of natural questions that, hey Akshat, how are you making 81,000 rupees? Are you not investing your time running Airbnb business? That itself is a full-time headache. So, okay, let me give a very quick context there. So there is an Airbnb manager whom I have hired. He will be paying me 81,000 rupees. So I am in a way sub-renting it. Now you will naturally say that, hey, how are you making like 81,000 rupees? So I will show you all the documents when I give you a property tour. But for the time being, let us assume that I'm able to make 81,000 rupees. So now let us move to 2032 and let us assume that I get a horrible return on this property. So what is the absolute worst case return that I will get? Absolute worst case can be zero, but let us talk about a slightly more realistic number. Let's assume a 2x growth in the next 10 years. This is almost equal to a fixed deposit return. Then at what price will I be able to sell this? I will be able to sell it at roughly 4 CR. Now here is the magical thing that my investment amount was 90 lakh. Now I'm able to flip this property at 4 CR rupee. So what is the amount of return that I'm making? I am almost 4xing my gain in the next 10 years by investing in a slightly more safer instrument. For example, a well-protected land on which a running business is already there, it is relatively safe. It is not as if that someone will do kabza on it. So by investing in a sensible instrument, I have been able to 4x my money, assuming a really bad rate of return. You might have a natural question for me that, hey, why did you not outright buy this? Why did you decide to take a loan on the property? Multiple reasons. Number one, when you take a bank loan while purchasing a property, the bank itself does the verification of your property. So you are safe. You are not getting into some disputed property. This is reason one. Number two, the interest rate environment right now is favorable for taking a loan. So right now I'm getting this interest rate at roughly 7.5%, 8%. In the future, it might go up to 10% also. So I'm taking a fixed loan on it, not a floating loan. Number three, I will be able to claim tax benefit on the interest. Number four, I will be able to show little bit of it as a business expense. So there are a lot of things at play. Therefore, I have taken a loan. I have not outright purchased it. Fifth and final, very important point is that I can keep on playing this game. For example, if I can identify 10 such more properties, then I need to have the capability to make this down payment, right? So therefore, I have not paid the entire thing outright, but I have taken a loan. With this equation out of the way, let me now systematically help you understand under what circumstances you should also take loan and how you should go about playing this game. So first and foremost, when you're taking a loan, you must have a very clear understanding whether you are taking that loan in order to purchase an asset or you are taking that loan for purchasing liabilities. Now, the definition of asset and liabilities itself differs from person to person. For example, if you call up a CA and check with him or her that, hey, is car an asset or a liability? The CA might say that, hey, it is an asset. But according to finance people like me, a car is a liability. In fact, it is a very big liability. Many of you might be taking EMIs on purchasing iPhones, or iPhone 14 has come, I'm going to buy it on the first day and take an EMI on my head, or this credit card is giving me like 50 rupee cashback, so I'll go and spend like 50,000 rupees on taking like some kind of loan. So please understand that you should generally avoid taking loans for liabilities. So let me just put some context. If you're a regular viewer of my channel, you would already understand the difference between asset and liability, but a very quick explanation there. So assets are things that put money into your pocket. For example, the villa that I'm purchasing, how is it putting money into my pocket? I will be getting a cash flow in terms of Airbnb rentals. I will pick that cash flow and I will service my loan. So that becomes an asset purchase for me. On the flip side, if you're purchasing iPhone 14, then what is happening? Whether you are getting a zero cost EMI, whether you are getting 1% EMI or whatever EMI you are getting, you are still purchasing a liability. Why? Because this takes money out of your pocket every single month. That EMI is something that you pay month on month. So then comes second point, that what type of asset you should purchase, and the natural response here is purchase good assets. So what is the definition of good assets? Good assets are assets whose value is likely to continue going up in time. That is how I would define good assets. A classic case in point would be the land versus flat debate. For example, land is finite amount. If you're purchasing land, most likely scenario is that it will go up in value. But on the flip side, there is a very high probability that the value of a flat will go down with time. Why is that the case? Let me quickly explain it. Now here is the supply and demand curve of flats. Now who do you think controls the supply of flat? Who decides that 100 more units of flat should be added? It is the builder. If they have financing, if they have already procured a land, they can easily create 100 more units. So understand this from an example that it's 2022. You purchase a flat worth 2 crore rupee. Now there is some kind of recession. All the construction has been stopped. You will be very happy that, hey, the supply of flats is not going up. You will be able to sell your stuff. Okay, when you go out to sell your flat, what will happen? That there will not be much demand because there is recession underway or there is some kind of economic issue. Okay, then assume an optimistic scenario that, okay, recession is out, everything is out. Now the economy is getting back on track. Then what would happen? Builders would start constructing a lot of flats. So they will be able to move this supply. So no matter how you look at it, when you purchase a flat, you are getting a bad deal. I'm not saying that you cannot sell a flat for profit. Of course, you can sell it if there is boom in that particular region, etc., but it's harder to sell a flat profitably compared to a land. So systematically speaking, which is a better asset? A land is a much better asset. Now, another way of judging a good asset is to compute the ROI of that asset or return on investment. So let us pick a couple of examples. So the first example is of upskilling. For example, let's say that you're spending 20 lakh rupees in order to complete your MBA. Your pre-MBA salary is 5 lakh rupee, and after your MBA, you get a package of 10 lakh rupees. Then should you be taking a loan to do this MBA? The answer is yes, you should definitely do it. Why? Because the ROI computation tells you that this asset is good. Similarly, please check some of the best courses that I've curated from upGrad. It is there in the description box. According to me, if you do these type of good courses from upGrad, there is a very high likelihood that the ROI of your investment is going to be positive. Now comes second good asset. For example, if you're taking a loan to create a business, and if you take a 10 lakh rupee loan, and after taking a loan, you are able to make a profit of 3 lakh rupee a year. Should you take that loan? The answer most likely again would be a yes. It depends on a lot of things, but yes, if you have the confidence that you will be able to turn your business positive and that loan helps you, then you should definitely do it. Now, can I give you some kind of a general rule as to how to do this assessment that, okay, 10 lakh loan, 3 lakh profit, is it good or bad? Or 20 lakh investment, 5 lakh rupees salary jump, is that good or bad? So for this, you need to calculate the payback period. So payback period means that you are taking 20 lakh loan and your salary jump is 5 lakh rupees. So what becomes your payback period in a way? It becomes 4 years. What is the payback period here? 10 lakh divided by 3, it becomes 3.33. So generally it is seen that if the payback period is less than 4 to 5 years, then it is considered to be a good asset. Now, this is not the only definition of a good asset. You have to consider your own personal circumstances. Let me give you an example. So for example, let's say that I'm 34 years old. Now I'm trying to make this decision that, hey, if I invest 20 lakhs in my MBA and I'll get a salary jump of 5 lakhs, should I do it? Should I not do it? Okay, from a finance point of view, it might make sense to do it. But from a personal circumstance point of view, that I have a young son to take care of, I have a family to take care of, I already might be in a good job. So I have to do what? I have to do a risk assessment of my decision. So I hope you get this picture. Now let me explain you the third key point about taking loans. So this third key point is called as over leveraging, because you will get super enticed by looking at the thumbnail of the video that hey, Akshat is able to turn his money into 4x, into a sensible asset. Let me also try to do it. Okay, please understand this point of being over leveraged. What is the meaning of over leveraged? Adani companies. No, I'm just kidding. Let me give you a proper example. So the general rule is that if the EMI that you have to pay every month, calculate the EMI of all the loans that you have taken, and if that number comes out to be more than 30% of your salary, then in general it would be said that you are over leveraged. So let's say that you have 1 lakh rupee cash flow which is coming in form of salary. You are paying 30k EMI by purchasing iPhone, by purchasing a house, etc., etc. Then are you in a good situation? The answer is yes, that this situation is fine. But you have a salary of 1 lakh and you are paying an EMI of 90,000. Is that a sensible decision? The answer is absolutely not. Now, why is that the case? Simply because of the viewpoint that if you are dependent on one or maybe even 2-3 sources of income, and if something happens to you, for example, you might have some kind of a health crisis, your business might not do well, or you might get fired from the job, then what would happen is that you might struggle to pay that EMI for 2-3 months, and then that becomes a big headache for you. A related point here is that I get so many questions that, hey, should I be taking a loan in order to invest in the stock market? The answer is no, you should not be doing it. This brings us to the fourth and final concept of volatility. So here is a very quick explanation of volatility, and volatility means certainty of cash flow. That is what it means. For example, here are 3 assets. For example, is stock an asset? Yes, because if you invest, the chances are that it will go up. Generally, that is what has been seen. What about house rent? That you purchase a flat and you rent it out to someone. The chances are that you are going to make money. What about gold? Is it certain that you will make return from gold? Yes, it is almost certain that you will make returns from gold. But the cycle of return is very, very long. It might happen that you purchase gold in 2022. And till 2028, you get 0 return out of it or negative returns. Then in 2030, you suddenly get like 10% return on it. So gold generally has a fairly long cycle. When it comes to stock, the cycle is usually around 2 to 3 years. When it comes to gold, the cycle is around 10 years. With house rent, the cycle may be a few months, depending on your ability to rent out your house. For example, you might be able to rent out your house for 12 months. Then the person will vacate the house. Then it might take you another 6 months to find a new tenant and rent them out. So the cycle becomes what? The cycle becomes 6 months. So I hope you get the perspective that as the asset becomes more and more volatile, you should be considerate in terms of taking loans for it. For example, the cycle for stock is fairly long. The cycle for gold is fairly long. So please do not take loans and invest in it. It is completely okay to take a loan for a house. It is completely okay to take a loan for a MBA. It is completely okay to take a business loan. It is completely okay to take a loan to start your digital business, etc., etc. I hope you get all these finer points. It all comes from practical experiences. And let me now very quickly give you a recap of the entire video. So here are 3 most important points that you should remember from this video. Number 1, taking a loan is not evil. It is completely okay to take loans as long as you are purchasing a loan to take an asset. This is point number 2, that you should purchase good assets. You should not purchase too many liabilities. What are good assets? Those are growth oriented assets which fit with your personal situation and meet your risk appetite. Third and final point, that please do not be over leveraged. Just because you like the debt game does not mean that you become over leveraged and ruin your financial well-being. I hope you enjoyed this video. Do check out some of the courses on upGrad and I will see you soon.